All right, wonderful. Well, thank you for joining us today. Today we have Diana Lin with us, and we are excited to have her on our webinar. For those of you who don't know me, my name is Divya Smith. I'm CEO and founder of Ascending Avenue Investments. I have 6 properties actively that we are managing today. 4 of them are in DFW, and 2 of them that I had invested passively in Arizona. We are in process of hopefully working out another cool one. If you're interested, we can talk about that at a later time. And I used to be in corporate America, was a technology executive, and decided for a bigger, broader purpose, and so switched over to real estate. And I'm just really excited and passionate about sharing the knowledge that I have gained over time with the folks in my community, especially in technology space and all the corporate America folks who don't have enough time to figure this out. So with that, I would love to take a moment to have Diana introduce herself. She has been in this space longer than I have, and she also has a architect background, but specifically the ground up development deals and the work she had done prior to switching over to real estate full time. Diana.
Yes, thank you for having me, Divya. Super excited to be here with you guys and also yourself, Divya. A little background of myself. First of all, my name is Diana Lin, and I am based here in Dallas, Texas, similar to Divya. So before I got started full-time into real estate investing, I was actually a practicing architect, a licensed architect for about 10 years. Did about 2 years of practice in China, worked on skyscrapers and also large mixed-use developments. Scale of projects I never really got to touch in the US, but it was a very great experience for me, get to be designing cool buildings. Then I moved over to Texas, where I'm from, worked in Houston, and then down to Dallas, where I'm stationed now, working on more commercial projects, so offices, hotels, and multifamily as well. Last project I finished was a 256 key hotel that I worked on from schematic design all the way to construction administration, just punch walking every single hotel key, hotel room. So I got into investing passively, actually. I stumbled upon the idea of multifamily syndication, and I love the idea of passively investing. And so I started that in 2018. And in 2018, my husband and I, we were both working professionals, W-2 jobs, and have no time to really go be active as an investor and shop around for deals. So what we do is that we network with other sponsors, and they come present us with deals. We review it, and then we invest with them, cut them a check, and then we're pretty much hands off for 3 to 5 years until it becomes full cycle. So that's what we did. We invested full time, well, not full time, we invested really on the side, passively investing into multifamily syndication deals in 2018 and 2019. And then in 2019, I actually left my architecture job to try to pursue and get more exposure into real estate investing. And it's really in 2021 is when I started to really shift to full-time real estate investing, because we had a personal experience that we decided that we need to really get more into active investing. So in 2021 is when I fully left architecture and was full-time onto real estate investing as a sponsor. So that's when we got our first deal. It was a 22-unit deal as a lead sponsor in Arizona. And we got our second deal in Tucson, and then we got our third deal in Dallas. And so all 3 of those deals are as a multifamily value add deal. And so now I'm shifting more into the ground up development, which is actually my true passion, to work on ground up development. And it's because my background as an architect, I want to really watch the whole process of ground up construction. So that's what I'm working on right now. And looking forward to sharing my knowledge of, as an experienced passive investor, but also as an active investor as well.
Yeah, thank you, Diana. So a question for you. So you had passively invested for 2 years before you became active. What was kind of that moment or that, turning point for you to decide that you wanted to switch from being passive to active?
Yeah, so that's a really great question. So it was really nice to be passive and not worry about the deal day-to-day operations. But it was really in 2021 when we got a bunch of deals that went full cycle, about four deals actually. So we started investing in 2018, and then a lot of deals went full cycle in 2021. So we were deciding about whether we do rinse and repeat and redeploy those capital as a passive into more passive deals. But it was more in that year is when I was actually pregnant with my second kid, and my husband, he was requesting his boss 2-year paternity leave, right? So they're telling him, it's like, yeah, of course you can take paternity leave, but just know that you're on point on your projects, right? So it wasn't really any paternity leave per se. It's like, so during when we actually, my newborn came out, and then my husband was not as available as we wanted to have him be available. So we realized at that point that we needed to take some drastic changes in our life to get a little bit more into to be more financially free, right? So we knew that passive investing is an avenue, but it's going to take a bit longer to get there. So if we switch to pursuing more of an active role, we'll get there faster, right? So I started to explore a lot of options to how to get more into the active role. And so that's really why we switched over to being active, because the once you become active into real estate, then you get the promote, you also get the fees from those deals, but ultimately you also get the cash flow, and you'll retire in a faster pace than you would do as a passive investor.
Understood. So Diana, I love the fact you shared you're passive, you invested for about 2.5 years, 3 years almost. Deals became full cycle, and then from there you decided you wanted to switch for family purposes and also for being more so involved in kind of doing your own deals and bringing it to your own community. So that's pretty awesome to see. I do want to ask if you're comfortable sharing what were kind of roughly, for folks who are newer to this space and just learning what investing looks like, especially in real estate. If you're comfortable sharing just rough numbers for some of those deals that came full cycle, and you said you had four deals that came full cycle. So
Mm-hmm.
I'm assuming there was a decent financial gain which allowed you to do that. Can you just talk a little,
Yes.
folks, what
Yeah.
in reality that could look like?
Oh yeah, yeah. Sorry, I didn't get to cover that. So essentially, for these multifamily syndication deals, when you're an LP, when you, well, I guess to step back further, right, just to kind of give a high level understanding of what multifamily syndication is the fact that for a person wanting to buy a commercial property, say for example, you want to buy a $10 million apartment, right? You borrow $7 million from the bank, but then you need $3 million down payment to purchase that apartment. Not a lot of folks like me and you would have the wherewithals to pull $3 million in our bank account to purchase that apartment. What we do is that the $3 million, we raise money, we collectively raise money as partners to purchase that property together. So $3 million you need, and each investor put in $50,000. Then you need 60 to buy that $10 million. But if each investor put $100,000, you only need 30 investors. So that's really what syndication is in a short explanation. But when we started in 2018, we put in 50,000. Actually, our first deal was a $30,000 investment because we were too scared to commit to a 50,000. It's like, okay, can we do a little bit less? It's like 30,000. Okay, no. And then afterwards, 50,000, then 50,000, right? And so we invested about 8 deals in 2018 and 2019. And we just kind of stopped investing just to see whether this concept of doubling your money in 5 years is actually going to come into fruition. Instead, the market helped, right? So in 2021, 4 deals went full cycle. So it was a 3-year hold. And the equity multiplier was between 1.7 to 2.3x, right? So what that means is that if you put $100,000 in, you get $200,000 back in 3 years, right? So that we saw the proof of concept that worked in 2021. So that's why we became believers, and we decided to go more full into the investing as an active investor.
Got it. Got it. Thank
Hmm.
you, Diana. And I couldn't agree more. So I would love to kind of just stress the point you shared. The market did help. And I think folks who were able to invest in that 2018, 2019 timeframe, very good. I think the prices did kind of skyrocket and right about 2021 early all the way through end of 2021. So really good time to be able to sell at that moment. Now,
Hmm.
I think the market that we have today, it has switched a little bit. The prices have dropped. So it's not a good time to sell for sure, but I know there are folks who need to sell, but it is a good time to buy. So the folks who I talk to in, day out, I remind them this is very similar time in 2007, 8 timeframe where the prices had dramatically dropped. For me, unfortunately, had only been out of college 2 years at that time. So I didn't have a lot of disposable income
Yeah, same here. Hmm.
invest at that time, but it's a perfect time for people if you have that disposable income. Now is the time because most of the prices we are seeing, especially if you can find a good deal, it's about 20 to 25% lower than what it was in 2021, and that's what most people will focus on. So that's a great
Right.
explanation. Thank you. Thank
Yeah,
you for
yeah,
sharing.
no, I mean, I want to kind of expand on that because, like, when during the recession, we didn't have the capital then, but we knew a couple years after, looking back, is like, okay, if we've invested back in the recession, we would have made a killing, right? So
Right.
let's hold on to our capital and wait for that next recession. That next crash didn't happen in 7 years; it happened in 10 plus years, right? So this is the year, right? Really, quote unquote, the recession and crash that's happening, that it is an opportunity. So those of you that are afraid about the recession, we see it as an opportunity, right? So we're in the sidelines drooling on, like, potential deals coming through, and it's so I think that if you kind of get yourself positioned to be educated how to evaluate these type of deals, then you're going to be in a really good position to invest this year.
Yeah. Yeah. Well, that's a perfect segue, Diana, to kind of jump right into the meat of this presentation, which is what are the four blunders we're going to talk about today from a real estate standpoint. And we would love, so just for the folks on the call, we're going to go back and forth and kind of share our experiences, but there are four critical things you want to be looking for as you're starting to potentially even think about investing. So let's start with number one, kickoff. What's the first blunder we should be looking at and looking to avoid?
Yes, and these are all kind of what me and Divya sort of brainstormed before this call. But when I was learning about investing, I thought that if the numbers worked, then everything will fall into place, right? After years of investing passively and also investing, numbers help, but it is not the only wherewithal to decide whether a deal is good. So, number one blunder is all that matters are the numbers. That's not true. What I learned over time is that what really helps steer the deal is the sponsors or the people behind the deal. So it's more of an operational, because numbers can look gravy on paper. It can look great for the cap rate and also the purchase price, and also the underwriting may look solid, but it means nothing if the sponsor themselves can't execute that business plan, right? So the captain of the ship is very important to vet. You want to make sure that the sponsor themselves have the experience and they have the capacity, they have the discipline, right, and the work ethic. Also have the moral values that is similar to yours, to make sure that they're putting your priority or needs over themselves to make sure that this deal will be successful. So that's
Absolutely.
something. Mm-hmm.
So Diana, like you mentioned, being very clear, the numbers are great. So you will start to hear, hey, you can get a 20% year over year return, which is pretty common. Usually the deals you'd see are 18 up to 20 to 22% year over year return. That's kind of the aim. But it doesn't matter, like Diana said, if the people who are working on the deal, they don't have the operational excellence in order to be able to deliver the business plan. And that,
Mm-hmm.
whether do they have the right connections with the property management? Do they have the right team in place to be able to work on that? And between Diana and myself, we have some experience of working directly with some property management companies that didn't work out, that did not
Mm-hmm.
treat our properties the way we would have liked them to be treated and really take
Mm-hmm.
take care of the property and respect the tenants and bring the community together. So Diana,
Mhm.
any thoughts on that?
Yeah, yeah. So it's not just the sponsor that you need to evaluate and vet, but also who else is on the team in terms of the vendors. So if you see on their deck that they're going to be partnering or hiring property manager, look into that property manager, right? Don't just take it for face value with the marketing lingo that they have on the website. Oh, they look like they're experienced. They should know what they're doing. I would, as a passive investor, now that I know more than I did 5 years ago, I would ask for the sponsor for, their references or their experience, right? Because a larger corporate property manager that may have thousands and thousands of units under the belt doesn't necessarily mean that they know how to operate this particular property within that market,
Mhm.
right? If this particular property manager has multiple properties, and say for example in this situation multiple deals in that they manage in Fort Worth but may only manage one or two in Dallas, it doesn't necessarily mean that they're going to do a good job, right? On top of that, you want to also understand that does this property manager focus more on class A management or class C management, right? Because the class A, if they have more experience in class A property management, they wouldn't have no idea how to, they would struggle to figure out how to maintain delinquencies and turnovers in the class C property. So you want to make sure they have relevant experience on not just the demographic, but also um, the class of the property itself. So property manager is definitely one as well. And so I would definitely want to make sure that the property manager is the right one for the project.
Got it. So, what I take as a note from that is bigger is not always better. And
Mm-hmm.
some of these big companies do kind of are boastful about everything that they've done, but they can give that detailed precision attention that the property may need. And we actually are talking from experience because we recently switched one of our property managers on a team, and we are seeing day and night difference. We worked really hard with this big name company, and for about 9 months, we tried, and we just didn't get the same kind of detail that we were looking for until we switched. And now
Mm-hmm.
it is, totally different. So it really is something we speak from experience as we have learned through it ourselves.
Mm-hmm. Yeah, I totally agree. It was just made me sleep better at night.
Yes, yes. So I'll pause here if there's any questions on it, and I'll look out on the chat. But before we jump on to the number two blunder, I wanted to mention that the sponsors who are on the team really critical to see, how well do they handle under things when they're not going well, and asking, even some of the questions from them, have they had any issues while they were managing, and hoping that they tell you versus, things don't go 100% right. So being very careful if you're working with sponsors or partners who are saying, we have had no issues, things have been perfect, they never go perfect. So being really careful and kind of watching out for that.
Yeah, I would say I would add on that. So if you're looking for deals to invest and you want to vet the sponsor, they are going to tell you everything positive about their resume, right? What I would do as a passive is to ask the sponsor for referral. So ask the referrals of other passive investors that have actually invested with them, but also past partners because they may have a different opinion about that sponsor, right? So that's something I wish I knew when I was starting off as a passive investor is to ask for referrals because you may trust this sponsor that you want to, you may have no idea how they actually work behind the scenes,
Yes.
right? So in order to protect your investment, then you want to make sure that you're doing the vetting correctly and ask whether the past passive investors were happy with the amount of communication and the direction of the deal that they're managing.
Yes, absolutely. Thanks, Diana. So with
Mhm.
that, let's jump to number two. What's the second blunder we can avoid as we start to invest passively in real estate?
Yeah, so you know, kind of adding more, yeah, it's kind of similar to number one where you kind of look at the deal and said, okay, well, looks like everything looks great, but the location is okay, but as long as we're going to be, pushing on this business plan, it should be good. But in but really location it really does matter, right? So number two blunder is location doesn't matter. Want to essentially work in a submarket or a market or a submarket that is strong in economics, right? The numbers, and you want to also look at the crime rate as well as the supply and demand for housing. What's the absorption rate or what's the occupancy of that market? You also want to see what are the other big industry players, or at least the companies that are moving into the area. Because me and you, we both know that DFW is a strong market, so that's why we invest in DFW. But say you invest in, say, for example, Sherman, right? Sherman has one big industry player coming there, but then that's not as diversified, right? You're gonna probably bet on that one tech company to help boost the strength and rent growth of the area. But what happened if next year decided, never mind, I don't want to continue building on top of it? Then you're just kind of screwed. You want to make sure that the the type of diverse economics is within that area, so then it can be protected from really being hit on one type of industry. So for example, um, when Houston is also not as diversified as DFW, is much more heavily dependent on the energy sector, right? So when the price of oil like start to topple down, then the occupancy for the apartment starts to drop as well, because the folks living in Houston are struggling to pay their rent. So you're gonna struggle because it's tied into one industry. So I want that's one of the things to kind of also consider is the type of economic picture and makeup for that market.
Yeah, Diana, that's very helpful. And one of these things, again, it's a lot as a passive investor for you to go out and research. So it's a question to ask to your sponsors. Why do you specifically like this location? Tell me a little bit more about what types of companies are around this property that you're purchasing. What is going to be a good number of people who will kind of stay in this building? And then what's the crime rate? I think that is a big one. So for me personally, so I'm from New Delhi originally, and like safety is a huge thing. And I grew up kind of in a big city. So safety was always a concern where I will still to this day go walk around a property before I purchase it and walk it at night. Do I feel safe and comfortable walking around it alone by myself? And if I do, I will then go ahead and even look at the numbers, start investing and doing my due diligence. But that tends to be
Mhm.
for me a deal breaker if I don't feel safe walking around. Uh,
Yeah.
we all have little things here and there that we kind of think of that are bare minimums for us, but location really does matter. So,
Hmm.
even in DFW market, we are actually looking at a property in Highland Park right next to Uptown. We know the property in the area is really very well suited because of the companies and, that are moving there.
Hmm.
But comparing that to, let's say, some of the South Dallas cities that are starting to switch over, but they're not quite there yet. And
Hmm.
so I personally, at this point in time, not comfortable investing there yet.
Hmm.
They may be at the verge of kind of switching over. But
Hmm.
to your point, knowing that market and sub-market is really important, along with the sponsor who's doing it. They should be giving you all those details.
Right, right. And just to kind of build on top of that is that, when I was researching to enter into a new market, say, for example, New Mexico, I'm used to the DFW, I understand it. But then when I enter into a new market like New Mexico, I make sure that I do all the research and make sure that there are the numbers there to support what we need. So, just to give you a specific example, when we're looking to build in the submarket of Albuquerque, we saw that there is like a shortage of 30,000 units in the area. So there is a dire need for housing. So, and also the fact that our multifamily is going to be one of the first to meet those absorptions, right? We're not going to be one of the 10 or 20 multifamily ground up that is coming alive at the same time, because then we're going to deal with competition and absorptions. But then if we're one of the first that will absorb those demand, then we're going to be in a better position, right? So these type of micro market studies to make sure that when you're entering it and you're building a new product, or when you say do value add, you want to make sure that when you're looking at the other properties around the area, if all of them are at the similar occupancy rate is 88% or 85%, there's something, they're dealing with something there. So you want to like turn your direction to a different market that has a 95% occupancy rate, right? So those type of analysis is super important when you look into a new market.
Yeah, Diana, thank you for that. And I think we are cruising right along and almost, hinting at our number three. I know there's a couple questions in the chat. I will talk about them at the end unless they are directly related. But the third blunder that we have is very much related to location, but it built on top of location. So let's talk about that for a minute.
Yeah, for sure. Yeah. So number three, one of the main blunders is that demographics doesn't matter as long as like everything else looks good, but it really does matter. So if you are going into a market or you're looking into a property and you are looking at it and wanting to, in order for the numbers to work or the deal to work, you would have to have rent that is about $1,500 a month. But if the area $1,500 a month but only supports $1,100 a month, you're not going to achieve your business plan, right? So when you are considering investing into a certain deal, you want to look onto the income level of the area. So a really good website, it's called city-data.com or org, I forget, but it has a lot of resource on looking at the specific areas based on the US Census Bureau, the average income of the area, not just income, but also the makeup of the folks that live there, right? So it has a lot of data in there. So you take that trove of information and process it how you like. But really, if you're seeing that this certain area or radius is are folks that are making $40,000 to $50,000 a year, and then you need to have a average income of 80 or 90, then there's no way that your product will actually fly because that certain demographic is not going to be able to afford it anyway. So you're going to have a property that's going to struggle with filling it up because it's too expensive, right?
Oh, yeah.
That's something that is super important.
Yeah, Diana, that totally makes sense. The rough numbers that we end up using when we do our underwriting in this space is the median income around that property that we're looking for. 50 to 60% of the income most people end up spending on rent, and we don't want it to be any more. So exactly how Diana had laid it out. If we are expecting folks to have a median income of about 70 to 80K per household, they will not be able to now sustain an apartment building rents that are more than 13 to 1500. That will likely be too expensive for them. So really having that idea of demographic income is really important.
Mm-hmm.
I have a technology and a corporate background, so I always like to kind of put it in a supply and demand format, right? So if I'm going to supply apartments that are going to be at a certain price point, I need to have the right demand for it. And if there's no demand, then that means we're going to have vacant properties. So again, just be really mindful. And, that's another question to ask your sponsors. What kind of people are living in that area? And the updates that you're going to make to the building, can they even afford it? Because you don't want to put in like expensive tech packages and expensive utilities that they may not be able to afford. So I think, Diana, you and I had talked about that as well.
Yes, yes. So, for example, one of the business plan that we're exploring into one of the value add deals is putting a smart tech package, right? That's going to cost an additional $70 per month per unit, right? The thing is that when you add a bunch of these packages on top of each other and the rent jumps from like $1,200 a month base to $1,500 a month, that's going to hurt in terms of the affordability, right? So you have the tech package, you also have the in-unit washer dryer, that's usually about $57 additional per month. And then there's CAM, it's like $5, and pest control, $7, right? All these little small, and also rubs, forget about rubs. So that's another $20 or $30. So you want to be cognizant of those fees that is total for how much the tenant themselves can actually afford. But not just that, but say, we're just to expand on the tech package. If you have a smart system hooked up in your apartment and you're trying to charge tenants $70, but they really don't want it, right? They don't need it. They just need a nice, clean place to stay. They're probably going to look from other places to rent at, right?
Yes.
So when you're trying to force a smart tech package that's typical for Class A products onto a Class C product, you should think twice.
Yes, exactly. So just for folks here, just to explain, we kind of talk about Class C versus A, B, and C. So A tends to be we have the class of the property and then the location. So is it a location A type, but in a property A? A usually means a newer property. B means usually 80s and newer, and then C is kind of 70s and older. Now, the same way we talk about locations as well, also the density and the employment or the median income. So A tends to be a little bit more, I'd say, higher income levels, B kind of mid-range, and C a little bit more so as we'd consider labor class. So all products appeal to different markets in that space. But the point you made, Diana, really, really great. It's great to have all these amenities, but if nobody's able to afford it, it doesn't matter if nobody's living there, right? So it's great to have all these utilities and make it look really nice, but if it's sitting empty, it's pointless. So really
Mm-hmm.
making sure you ask your sponsors you're working with what kind of amenities and utility upgrades and things that they're providing, and can their demographic that they're planning for pay for it?
Yes, and one thing that we do as active sponsors is always looking at comps. What are the other properties nearby us are doing to attract tenants? You don't want to do too much because you're not as competitive, right? You also don't want to do too little because you're not as attractive. So you want to make sure you're kind of just at par, but like you're a little cheaper and offer a little bit more.
Yes.
Yeah. So I mean, you when you do the capex as well, it's like you don't want to put quartz countertop, something that costs a lot more during a unit turn, when really the market for the same class and area, they are all putting granite countertop, right? It's significantly cheaper, and people are paying the same rent for quartz countertop. Sorry, yeah, paying the same rent for like a granite versus quartz. Why put more money into a turn when you can get the same kind of rent for a granite countertop? So those type of market research are essential.
Right. Absolutely. Absolutely. It kind of goes back to why would you build a supply for which there's no demand? And if there's no demand for those expensive utilities, it doesn't make sense. So that's
Mm-hmm.
great, Diana. Thank you for that. And we'll jump on to the final fourth one. So what's the fourth blunder folks can avoid?
Yeah. So the fourth and final one is that experience doesn't matter, which is very much incorrect. Experience is very important. So, and we're talking about the experience of the I think we talked about the sponsors, right?
Sponsors. Yes. Yeah.
Mm-hmm.
Sponsors.
Right. Mm-hmm. Yeah. So it's important to make sure that if the sponsor have relevant experience of the property, managing the property, right? If this one sponsor only has experience of managing single family rentals and then they're doing their first multifamily deal, then you might want to think twice. But if they're partnered with someone who has 10 to 15 years of running apartments, then yes, they have a partner at least on a team to help run the operations with them, right? So there's a lot of emphasis and importance on that. You want to invest with someone that has relevant and the experience to run the property.
Yeah,
Yeah.
absolutely. One of the terms that we end up using, especially in this space, is called full cycle. And you'll hear that. What truly that means is, somebody who has purchased the property and sold the property after completing their business plan. Now, I say specifically they've completed the business plan in the time frame when some folks did buy it, and because there was such a natural rent growth, they didn't have to do much to the property. It sold for profit anyways. So the key word here being, ask the sponsors you're working with to see have they truly gone full cycle where they purchased a property, completed their business plan, and then sold it. It's less about the time frame, but more about did they actually deliver what they promised, and if they have completed all the business plan work to not only update the communities that they are, going in. And the reason I call that is it's really near and dear to my heart. If you're purchasing these properties, it's not just about profits. The goal is really to build these communities and build them better. So if we are updating these units, it not only attracts the right tenants, it builds that safety in place. A lot of these properties will end up adding security cameras outside. It's an updated dog park. It's a better way of living. So we don't want to just increase the rents and not show that value to the community. Those values have to be there with the sponsors you're working with.
Right. I mean, just to have a safer and better community in itself, it actually provides a better return because they have higher tenant retention, right? So those are super important because it's not really just the numbers itself, because then you start to just look at numbers and not really about the residents, right?
Absolutely.
Mm-hmm.
So with that, if you have more questions, please put them in the chat. I'm going to start answering some of those, and Diana, I'll read them out loud. If you want to take it, feel free. So Raj, your first question. So would you say it is important to build knowledge, experience as a passive investor before becoming an active investor? If so, what tools would you suggest for somebody new to learn?
So that's a great question. And it's always come up for debate on how you should go about when you start to invest. And so my journey is specific to my journey, and your journey is your journey, right? But to give you kind of context, right? Before I invested passively into multifamily, we as in me and my husband, tried to do our own duplex development, right? About 2 years prior, we started passively investing. And what I learned from that mistake, the fact that I tried to do it without any experienced partner, and didn't have a mentor or a coach, just kind of read a bunch of books and said, okay, let's do it, right? And so I recommend partnering with someone to do, whenever you do something new, right? Because in the end, you're paying for the price of doing investing either in two ways. Like, one is the price of making your mistake, and so that mistake can be costly, but you're learning from that experience. Or number two, you pay for a mentor or coach to guide you to the process, and then you're not going to make those mistakes. So you want to evaluate what you want to do. If you do it by yourself, you're going to make mistakes no matter what, right? As much as you think that you're a genius, you're going to make mistakes. So that's one of the things that I realized, now looking back, is that I tapped into a local or a duplex or a single family home developer to help me get to the finish line, then it would have been built. But we didn't, because we thought we can do it ourselves. So we tried to do it ourselves, and we didn't, because we couldn't figure it out. And so we did, right? So that's why we stepped back. It's like, okay, you know what? We need to slowly get into this without jumping into development. Let's go straight into multifamily value add as a passive. We're going to invest passively into other people's deal who are experienced, learn from what they're telling us or what we are seeing, then kind of take note for us. And then after a couple of years, then we're like, okay, I think we know enough that we're going to try to do our own deal. But this time, for multifamily value add, if we were to do our own deal, we're going to hire a coach, right? We're going to get a mentor. So that's what we did. And so that paid off huge, because I prefer to have someone look over my shoulder to make sure I'm doing it right, because I have investors' money into the deal. I want to make sure that I'm doing them right, to and have an experienced partner and mentor to walk me through the process. So I think it really depends on your preference, but I would recommend to have a partner if you do active deal. If not, then stay passive and learn from that process.
Yeah, Diana, I couldn't agree more. And I think I took a similar path as well. And I ended up wanting to learn about it first. I learned about it for passive investing for about a few months before I actually invested passively. And from that passive investment itself, It's amazing to see how much you don't know. So I would start reading through the reports, monthly reports I'm getting. I would go to the meetups. I would start to understand it from folks. I think one of the things also to share with this group is you're not always going to want to be active investor. So I did join actually a mastermind program, got coaches, learned through it. One of the statistics, even within that group, is I think it was a group of 60 of us, 60 to 70 of us, and maybe 20% ended up doing active. Quite a few, even the ones that I know about 10 women in DFW who had signed up with me, only 2 or 3 are actively at this point in time. They decided it wasn't for them. So, it's not always just about kind of we talk about this shiny penny syndrome, but it's not always about, what's there. Do you even enjoy it? Because some people said, you know what, I love my W-2 job and I would not leave it to kind of do this actively as investing. For me, the passive option works really well. So I think that give yourself time and space to figure out if that's the path you want to take. So
Yeah,
that's
yeah.
probably my recommendation there.
Yeah, try both and then see what you like and stick to that, right?
Right. So Lucy, you asked a question I don't see. Oh, Lucy, I see you there. Do you believe that it is the right time to invest now or next couple of months? How do you decide when it is the right time to invest? Can you unpack that criteria a little bit more?
Hmm.
So I guess,
So, sorry, go ahead.
yeah, Diana, feel free to jump in, but a couple of things I would add. Investing is a personal choice. You have to be, and I just wrote a post about it actually last week. If you do not have so there's 2 or 3 criteria in my mind. If you have a full-time W-2 job and you have not been maxing out your 401k, especially when they do percentage match, 100%, like make sure you max that out. Second is make sure you have enough rainy day savings for yourselves. I like to kind of do 6 to 9 months of savings in my savings account related to expenses to make sure that you have all of that covered. And anybody who invests with me, I usually will ask those questions to make sure, hey, you're financially comfortable in order for you to now invest, because there's always an inherent risk when it comes with investing. Now, is it the right time to invest? Like Diana and I were unpacking a little bit earlier. For us, with where we saw prices for the last 2 to 3 years to now, they're dramatically less for us. And if we can make a deal work where we are finding sellers who want to sell their properties at the current interest rate and what the price we would be willing to pay, it's a good time to buy from our point of view. And that's where we're starting to kind of look at more and more investment opportunities. But I will also pause here. So I do primarily value add sort of properties already pre-built, adding on. I also want to just give a moment to Diana to talk about the newest deal that she's working on and how that is so transformational, especially for the area and neighborhood it's in.
Yeah, yeah. So, the deal that I'm working on is, and I kind of touch upon this earlier, is a ground family development. It's a 150 unit deal in the suburbs of Albuquerque, which is called Rio Rancho. And so it's at a point where Rio Rancho is needing multifamily, right? So, which is one of the market research that we did, and saw that there is an opportunity to build in that area, right? So, we also know that Intel is investing another $215 million into the area in their plant. And we also know that Rio Rancho has one of the top school districts across the nation because they're trying to attract these tech families to relocate into Rio Rancho. We took all these factors and are moving forward with a deal to essentially build a ground up multifamily development that will address those needs, but also will end up being a long-term hold. So once we develop it in 2 to 3 years, we're just going to hold it and cash flow it for X number of years. We don't plan on selling it. So it is one of the strategies that I've been exploring this year, is that instead of purchasing properties and holding it for 3 to 5 years and selling it, why I think ultimately the goal for real estate, at least for me, is to hold on to it forever and get just 3 or 4 properties and hold on to it forever, where you're retired and you'll get mailbox money and live a lifestyle that you want, right? So that's what we're doing for this development, is that we're going to build it, we're going to hold on to it, and we're going to just hold on to the property to cash flow. So.
Yeah, thank you, Diana. So if you're interested in learning about the new development deal, reach out to Diana. But like we were mentioning, there's quite a few asset classes. So all comes down to the returns you're looking for, the strategy that you're looking for, and also the risk and reward associated with each one. So, explore more, ask those questions as far as the risk and the reward, depending on which asset class kind of interests you. Um, I am going to go to the next question. Raj, so your next question is, what are the things you look for in a market to evaluate potential, and how would you go about gathering the details for the analysis? So we touched on that a little bit. Specific to the market, how do we evaluate potentially? So, the few things that we look for, and Diana, feel free to jump in here as well, is the demographic data is just really critical. You want to make sure you understand specifically the neighborhood, the areas you're looking to invest in. What is the average or median income for that neighborhood? Because that'll tell you the rents you're looking to achieve, can you even achieve them? So that's one. The crime rate, the safety scores, and all that. So that becomes critical as well. And then the third thing I tend to look for is, what are the new companies and any other new uh, businesses that are moving there in order to kind of generate a higher demand. So again, supply and demand, very critical. So think about that. If we are supplying, say, even updated units, higher price units, can the demand, can the demographic afford it? So those are three. Anything else you'd like to add to that, Diana?
Yeah, so even as a passive investor, I mean, it depends on where you're looking at it as a passive or active investor, but even if you're, doing both, when you're looking at a deal, you want to make sure that you get comparables, right? It's like you want to get it from a broker that has access to CoStar, or you can actually call around yourself on nearby properties to make sure that they're getting the numbers that they say they're getting in that what the deal deck is projecting that they can get, right? So making sure you do your market research, and I think the biggest thing about a deal is whether or not you can achieve those numbers. So you want to make sure that their projections in the underwriting make sense. We like to see, and whenever we evaluate deals as a passive investors, a conservative 3% rent rate growth, not the 7% or 10% that you see sometimes in other people's deals for Arizona or even for Dallas, right? That's not, it's possible they can get it, but we want to make sure that it's conservative in nature. So just look into that underwriting to make sure they're assuming conservative numbers. And then for the market, you can get that market report too from the brokers, right? And probably don't need to get market report from one broker. You can get it from multiple brokers and make sure that educated and aware of the trajectory of that market.
Yeah, yeah. Thank you, Diana. So that really helps. And Rob, your question. Okay, syndications focus in its own marketplace. How would you differentiate the type of market? Now you're into your targets compared to ascending avenues. So I'll take a stab at it and just to share, and then Diana, feel free to jump in. So the my focus primarily with ascending avenue investments has been to focus starting with DFW market. I may look into future markets here in future, but my goal still remains DFW market. I know the space, I know what goes into it. And I'm focusing still primarily on Class B properties that require updates. So what we would call here is value add properties. So these properties are built in, existing, but they haven't had, love and care that it required. So our goal is to kind of buy those properties that may have been neglected, update them, ideally in really good locations, so that we are able to then increase the value of it in the community along with the rent. So it's a win-win both for people investing in it and also people who are living there. So that's really been my focus. And I know, Diana, your focus has shifted more so in ground up
Mhm.
development. So yeah, I'll take
Yes.
you take that.
Yes. Yeah, for sure. Like we started off really focusing on the value add side. And even for the value add side, what we tend to have a little bit more emphasis on is the partners that we have on our team to make sure that the deal is successful. So even though we're based in Dallas, our first deal was actually in Arizona. And the reason being is because we trusted and know the partners that we have coming into that market. And we also did our own research as well. And we're able to kind of successfully acquire and operate it. And we still have it now, but we tend to find deals that's a little bit more heavily focus on making sure that whoever we partner with and bring the deals to our investors, that we have a partner that is well versed and experienced in doing these type of deals, right? So we did value add for a couple of them, and then we our latest deal was is right now a ground up development, and it's our first ground up development, but we are not going to do it with a blind eye. We're going to partner with someone who's been doing it for 20 years. So we are partnered with someone who's been doing development for 20 years, and so we bring that to our investors to kind of bring along with us in the journey, but we also make sure that we're vetting it, making sure that it's a good deal, and doing our own market research as well before we bring it to our investors. So, we're still doing value add, but kind of focusing a little bit more on development. So I think that when you ask your sponsors what type of deals they're currently focused on, that's a great question to ask, but every year they may shift it a little differently. You want to ask before you invest with them.
Yeah, that's it. That's a great thing. So I know we are right about at time here very soon. So Diana, if folks wanted to reach out to you, how can they reach out to you? What's the best way to contact you?
Yeah, you can reach out to me via email, and my email is Diana, Diana, at navi-ventures.com, and I'll put this in the chat. But you also can connect with me on LinkedIn, and I think you just got to put Diana Lin, comma AIA, which is my architectural registration acronym. but yeah, you'll find me on LinkedIn. That's an easy way to reach out to me as well.
Yes, yes. Well, I appreciate everybody who joined today. Ariana, good to see you. Elliot, I always message you on LinkedIn. So all good. Lucy, Madhu, Niku, Raj, Robin, Tori. So thank you for joining and great to have you. We'll have the recording available as well later on. Have a great
Thank
day,
you,
everyone.
everyone. Thank
Thank
you so
you.
much, Divya.